Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you. It's been about 2 weeks since we last spoke.
Gold, is it doing something interesting?
I really think it is. I mean, people are more focused now on actually Bitcoin and in the stock market as it's managed to bounce or rally in the past 2 weeks. But I think from a long-term perspective, to me, gold is more compelling where it is right now because it's still in a long-term consolidation that really started last year in the month of August. And gold fell from making a high of 2050 abouts in 2020 down to right under 1700 this spring. Then it rallied back up to 1900, and it fell and dipped really into the month of October as the Treasury bond yields in the United States started to tick a little higher, and the dollar did the same thing too. And historically, gold trades opposite to the U.S. dollar. So when the U.S. dollar goes up, gold goes down and vice versa. However, the rally in the dollar, when you look at a long-term chart, it's just looks like a bounce. I mean, the dollar is still well below its high of 2020. I mean, and it's not even up 10% from where it was in its latest low made in June, which is right below 90, and now it's trading right below 94. So it's just a 4-point move in the U.S. dollar index. But it's the move up in yields that has helped the dollar bounce. And to me, what's interesting is that seems to be losing energy. Yields are still, strong, but the dollar rally is starting to falter, and gold at the same time is firming up. And I think in the long run, perhaps next year, we're going to see a situation where yields go up, at least in the corporate bond market, and the dollar goes down, which would be the most bullish scenario for gold. But if you want to look for a catalyst or an event to explain what's been moving these markets, I think what we have to look at is the Federal Reserve meeting scheduled for 2 weeks from now. They're widely expected to announce the start of a reduction of their quantitative easing bond buying operations. So gold has fallen into that. The dollar and bonds have made moves into it also. And I think when the news passes, we're going to see more money come into the gold market. And, gold, I think, is set up to be the big story of next year because all it has to do is break through 1900 to get out of this consolidation phase and have the type of move that finally starts to catch people's attention. And I just point out, one final thought about it is when you look at any market, you really are looking at long-term cycles, or I should put it another way, you're looking at short-term action, but it's the long-term cycles that are the most important thing. And if you look at the 1970s, in 1976, there is also a drop in gold and a rally in the stock market, and the gold drop ended a few weeks before the Federal Reserve began a new cycle at the time of raising interest rates. Inflation was exploding. They're trying not to do it, but they started doing it. They had to. And gold fell into that expectation and then bottomed weeks before the start of that rate hike cycle. And then from then on had really the most famous and epic move in our, historical memory in the markets the past 100 years, from 76 to 79. So I think something similar is sort of in the cards for gold going forward over the next couple of years. And this meeting, at a time that we're even talking now, in hindsight, could look to be a great turning point, or have been a great buying point. Because look, the inflation trend is real. Every single day or week, you can find a story about a new commodity that's making new highs. Just the other day, I was reading how zinc is making a new high, aluminum, copper, industrial metals, and I own stocks that are involved in that sector. And one of them is a big cap stock, an Indian company that mines these various metals, and it was $3 in 2020, and it rallied up to 15 by March, and made a new high yesterday, briefly touching $20. So this is something making new highs, and there's pockets in the commodities like that. I mean, energy stocks are doing great. Oil keeps bumping on 52-week highs. And I think I mentioned last time we spoke that in the commodity cycle, typically commodities will correct in the fall, really into November, December. Oil typically will peak in July, the first week of July, and then have some sort of dip into Thanksgiving. But it didn't happen this time. Instead, it's going up as we speak. So I think that's a sign of how strong the underlying inflationary trend is across the board in commodities. And it is helping other metals go up, but it hasn't yet lit a fire under gold and silver. But I think it's just a matter of time before that happens. So, if I was to talk to someone and they said, what's one thing I would buy now? I would say buy gold and silver and the mining stocks, as far as having the best opportunity from this, moment over the next couple of years.
On the energy front, I think Europe has maybe taught us a lesson that when you go to alternative energy like wind power, it's not always there. And then you have a cascade effect. You have blackouts. You have gasoline shortages because you don't have enough truck drivers, which is unrelated. But just on the energy front, and then you're going to rely on Russia, who likes to turn off the natural gas whenever they feel uppity or they don't like your behavior. Ask Ukraine about that. Is this going to be something we have to keep an eye on here in North America? Don't be too quick to go and trash all of your fossil fuel plants or even hydro projects.
I think so. And, one kind of simple explanation for this sort of thing is, look, the oil and energy markets as a whole, they have functioned in our capitalist economic system for decades. And yes, there can be temporary shortages or things that happen that can influence the price of energy. But we have had a fairly stable system. We haven't had that many dramatic sudden shifts in the energy market up until recently. And I would suggest there's two reasons for this. One is that what we're seeing in these countries and in the things that you're talking about, one of the things it is the governments of England and China is doing these sort of things too. They're trying to intervene in the energy markets through top-down command and control policies, and it's just frankly more difficult to implement without causing a massive disruption one way or the other. You can't really control the entire energy market, and when you try to make dramatic changes through government policies instead of just letting the profit motive work things out, you're disrupting, you're causing a disruption. So it's China, the story there is that they're making edicts that they want to control the amount of energy cities and companies and power plants are using. So they're kind of putting them on a ration system, which is causing blackouts and places that have to shut down, even factories, which is disrupting economic production, which can trickle over to higher price of goods in North America, another contributor to inflation. So these things have widespread impacts, unintended consequences. I guess that's the best way to put it. But the other thing too, the second factor is I really believe that we are in an underlying inflationary trend that exists, regardless, because last year when we saw the price of oil in the futures market briefly go negative, what we saw at that moment was a secular bottom in the commodity markets. And from then on, the price was up. The underlying trend has been up, and it's going to continue to be up across the board for all commodities. So I think that's a big part of it, and why that's happening. We could talk about quantitative easing, the interest rates being low all over the world, and when you take off quantitative easing, you're still in a dovish policy. Why do you have that? The legacy of all the government debt in the United States is, the most talked about example, but Europe has it too. England has it, Japan has it, China has it, and so forth. And the economic shutdowns and the crisis that happened last year just exacerbated that situation. So there's so many moving factors that it's perhaps impossible to stop this process of inflation from continuing going forward until it just finally the cycle runs its course. So I think the best thing from an investment standpoint is just accept that this is what is happening and position your portfolio accordingly to benefit from it some way. Energy stocks is an easy way to do it, but there's other commodity stocks. I've talked about gold and silver, of course, but energy stocks, you get the bigger dividends. And then at the same time, what we really haven't seen, except in the world around us, in the economy, but in the financial markets, what we haven't seen are really negative impacts of inflation. It really hasn't caused the stock market to take a hit, except, every once in a while, a temporary fear now and then. We saw that a little bit in the spring, when it was first recognized that there'd be higher CPI numbers coming in by summer, and they did. But I do think we're eventually going to see the market react negatively, the stock market, to what's going on. Maybe not next week, maybe not even before the end of the year, but I do think there will be a negative impact from this because it's gonna increase the cost for companies. It already is. And the people are just simply ignoring that fact for now.
We'll have more with Mike Swanson right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Mike Swanson. Mike, the computer chip shortage continues, and we're hearing that the world's biggest chip maker in Taiwan is going to build a major plant in Japan, but that won't come online for another couple of years. And, of course, there's a shipping container shortage. There's a shortage of truck drivers to get those chips distributed once they're made. Is this chip thing going to be hanging around for quite some time?
Oh, yeah, I definitely think it is, and none of the chip companies have said otherwise. I mean, they're all projecting this. They don't look but so far ahead, but from what I've seen, they talk about this continuing next year. I mean, I've seen talk that it could end next year, but they talk like, oh, it'll end by the end of the next year, in the fall or something. But that's a projection that's 6 months out. It's really further out than most investors that are playing the stock market look. So I don't know what to really make of it. And, I'm not expert enough in the chip industry to know. But that said, I do think the past quarter, of economic data does have long-term implications that suggest that this could be a troubling factor for quite some time. So when the spring was ending, economists and the Federal Reserve were projecting economic GDP growth for the third quarter in the United States to be above 6%. Well, by now, the official numbers haven't come out, but the Federal Reserve Bank of Atlanta does a daily update of real-time figures, and they've lowered that projection to 1.3%. So that's a huge deceleration in the rate of economic growth. So we saw a huge boom after things bottomed out, and that boom is now really petering out. I think we're, from a GDP standpoint, going to repeat something like we saw in the 2000 or 2010 too decade. That's just kind of sluggish growth, which doesn't suggest, a booming environment for chip companies. But more important than that is one of the big themes of the summer was that in the United States, at least, when the government assistance programs that were designed to help people, weather the COVID lockdowns, hundreds of dollars a month in benefits, well over $1,000 for many people if you add them all up. A lot of this expired in September, and a lot of people expected that once it expired, many people would return to the workforce. Well, that didn't happen. We found out just the other week that when the September unemployment numbers came out, there were 130,000 new jobs filled. However, over 300,000 people left the workforce. So there was not an employment boom, there was the opposite. And most of the people that left fit into one of two categories. There are people who lost their jobs and were over 60 and just made a decision not to go back. Or people younger who have children and aren't going back because the cost of daycare has gone up, or in both groups may also be worried about the catching the virus still, because many people are not vaccinated in the United States, or they're just scared. I mean, the United States partly is a culture of fear, where there is always something to be scared of. I mean, that's how politicians in the media present the rest of the world to us. Ever since I was born, I mean, it was the Soviet threat. They're going to get us with nuclear weapons. Then it was Saddam Hussein as Hitler. And then the scare and threat of the terrorist alerts, code red, code yellow, changing every week. And when that decade passed, then the market crashes and everything gets bad. Then Trump gets in, and now it's the fear of China. It dominates much discourse. So there's always a fear element, and people are just gotten used to living in fear. And I think many people carry that over into their daily life now. So I don't know when. What I'm trying to suggest is the data, and I think just implies that there are people that are never going back to the workforce. And this is also happening in other countries. China, there were stories that there's an entire movement of young people in China that they say they're laying down. That's the phrase. And what it means is they're trying to drop out and not work at all because they don't think they can get ahead. And that's another factor in all this is the cost of real estate has exploded so much. Yes, the easy Fed policies have pumped the stock market, but it's also made real estate skyrocket so much. Yeah, that's good if you own a house, but if you're a young person, your rent goes to the moon, and the housing prices are so high that you may conclude that you can never really buy a house yourself, and so you really don't have the type of future that your parents or someone older than you had. So this is a reason people also are giving themselves to try to drop out of society or not become a productive member of the workforce. And when you have entire segments of society that make the decision, I don't want to be productive. I don't want to be a productive contributor to the economy. I want to avoid that. Yeah, that's a negative situation. And this isn't just the United States. I'm saying this is a problem in many places. In China, as I mentioned, it's the laying down movement is what they're calling it. So this is a way to say that many industries are facing this problem, and the chip sector is going to be at the forefront of it if it is already. They're going to have to raise wages to get workers in the end, and already we're seeing strikes in sectors in companies that their workers decide I'm going to use this mode to get higher pay. Kellogg's is on strike. The John Deere company, the United Auto Workers have gone on strike there. In fact, there is almost close to a record number of strikes going on in the United States this year since World War II. It's the third. If you ranked all the years, it's third place. Only 2 other years saw more strikes up to this point, October, than this one since 1947. Actually, that's the year.
Wow. And of course, we just got figures in Canada, inflation running at a 20-year high, officially 4.4%. And if the government has found 4.4% inflation, if you talk to somebody like John Williams who runs Shadow Stats, the real rate then is probably 8 or 9 or 10%. I hear people's rent has gone up something like 21% for some people who don't have rent control. And of course, when a landlord changes tenants, if you get evicted, then they can charge whatever they want for the new person who comes in. It's just if you've been living in that apartment that the rate might be rent controlled. So there's a lot of pressure on people just trying to survive, and that always leads to conflict. Is there a way to make money on that? Printing picket signs?
I think, I kind of made this decision myself a year ago, and I still think it's the right one. And the answer to your question, I went and looked at the 1970s. Nothing's going to repeat exactly, but the 1970s was the last time that there was high inflation in the U.S. economy and sluggish economic growth. And the sectors that went up the most that decade, I already mentioned energy and gold, and that's obvious, but real estate did well, and so did REITs. So I've personally invested roughly 14% of mine, brokerage accounts are in REIT stocks. And these are stocks that do pay a big dividend. There's an ETF for them that I own in my retirement account, RWR, but it's been one of the best performing, ETFs or sectors in this year. And I think it's likely to do what it did in the 70s, and that's continued to outperform the S&P 500. So that's kind of my answer. And the thing is, like you mentioned, real estate companies, they have the ability to raise rents and react to inflation. They can do it much more easily than perhaps the John Deere company or Ford or something. So I think that's the solution, if you want to benefit from it. Of course, I'm too lazy to go and try to, invest directly in apartments or something. So I just buy the stocks.
What are the Robin Hooders up to? It's fascinating to see what our, I would call them micro junior day traders are up to.
Well, I actually think, I need to find out, we'll find out, when they report earnings, is the trading activity shrinking or growing? Are they doing more trades or less trades? And I think that's going to be a very interesting development when they do start to do less. Because I do think I see hints that it could be that they're all in, or we've reached peak Robinhood. The Robinhood company launched a marketing campaign to try to Target. They already got a third of college students that have opened up accounts. They're trying to get the rest of them by offering a promotion where if you have a college email address, they'll let you open an account without putting any money in it. And the Robinhood company will give you $15. So to me, that's a sign that have saturated the entire market and they're trying to go after the only thing left, which is people with absolutely no money. Which if that's the case, then who's gonna, keep buying these stocks? So to me, that's a big danger factor, in these meme stocks. I mean, cause I think it's dependent on new people, opening up accounts and buying these things. But when I look at the list of the top 100, there also hasn't been a lot of change, which suggests to me also that their trading activity may be shrinking in their importance in the stock market. So when I look at their top 10 list, I'm looking at it right at this moment, there's nothing new on the list that wasn't on there 6 months ago. So the only stock I see new in the top 20 is the Robinhood company itself, Hood, because it wasn't trading 6 months ago. But if you look at that stock, it's stagnant. It had an initial pop in August, but it went all the way up to 85, but it's trading at 41. And the low was 40, this month in September. So it looks like the stock itself may be saying that the bottom line earnings or revenue for Robinhood may not have a bright future to it.
Mike, thank you so much for chatting with us.
Thank you. Great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. If you have any questions for Mike or any of our other guests, you can send them to info@HowStreet.com and we'll ask that question for you. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.